So, what exactly is IFRS 19? In a nutshell, it's a simplified accounting standard specifically designed for subsidiaries without public accountability. Think of it as a streamlined version of the full IFRS accounting standards. The International Accounting Standards Board, or IASB, created this to reduce the complexity and cost of financial reporting for eligible companies. Now, you might be asking, who can actually use this? Great question. IFRS 19 is intended for subsidiary companies that don't have public accountability. This means their shares aren't traded in a public market and they aren't financial institutions like banks or insurance companies. Also, their parent company must prepare consolidated financial statements using the full IFRS standards. So, if a subsidiary meets these criteria, it has the option to adopt IFRS 19 instead of the full, complex rulebook. It's an optional standard, not a mandatory one, which gives companies flexibility. So, what's the big deal? Why is this so important? The main benefit is a massive reduction in disclosure requirements. Full IFRS requires pages and pages of notes to the financial statements. IFRS 19 cuts this down significantly. For example, detailed reconciliations for things like property, plant, and equipment, or complex disclosures for financial instruments are simplified. This saves an incredible amount of time and money, not just for the accountants preparing the reports, but also for the auditors reviewing them. Let's get into some specifics. While the recognition and measurement principles of IFRS 19 are largely the same as full IFRS, meaning how you initially record and subsequently value your assets and liabilities has changed much the presentation. And disclosure side is where the magic happens. The standard essentially says, look, the parent company is already providing all the detailed disclosures in its consolidated statements. Why make the subsidiary repeat all that work when the information is already available to users at the group level? For example, under IFRS 19, subsidiary wouldn't need to provide detailed disclosures required by IFRS 7 on financial instrument risks, or the extensive disclosures for share-based payments under IFRS 2. It also simplifies the disclosure requirements for leases under IFRS 16 and employee benefits under IAS 19. The focus is on providing relevant, used information for the subsidiary's standalone statements without the unnecessary burden. This is a huge win for efficiency. It allows finance teams and subsidiaries to focus their energy on more value-adding activities rather than getting bogged down in compliance paperwork that might have limited benefit for the users of their specific financial statements. It makes the entire financial reporting ecosystem for corporate groups much more logical and cost-effective. So, to recap, IFRS 19 is a new, optional standard for subsidiaries without public accountability. It keeps the core recognition and measurement principles of full IFRS, but drastically simplifies the disclosure requirements. This leads to significant cost and time savings, making financial reporting more efficient for eligible companies. The standard is effective for reporting periods beginning on or after January 1, 2027, but early adoption is permitted. So we might see companies jumping on this sooner rather than later. Thanks for watching, and I'll see you in the next video.